In this video, I asked the question, why would you not spread bet if you lived in the UK? Stay tuned. Hey traders, warm welcome to you. So if you're from the UK, you're probably very familiar, if you're into trading as well, you're probably very familiar with spread betting. Spread betting is ultimately just trading, but in a tax efficient wrapper. So for those of you not from the UK, CFDs are probably the closest kind of thing, but spread bet is ultimately you're betting on the direction of the underlying asset, like the FTSE, the DAX, the Dow, Apple, whatever it may be, and you're betting in pounds per point, which is ultimately the same as 100 shares. Like 100 shares is the same as £1 per point. So it's really almost identical to actual trading in terms of the more you're right, the more profit you're going to make, the more you're wrong, the more money you're going to lose. So why would you not spread bet if you lived in the UK? So the tax efficiencies make it very attractive for UK residents. For 99% of people, it's tax free. In other words, there's no capital gains tax to pay. Now, there are some slight differences in circumstances with specific people. We're going to go into each individual one, but for the majority of people who are casually trading, kind of part-time, doing whatever they're going to do, having a trade from time to time here and there, even more active traders as well, majority of the time, there's no tax to pay. However, so if that's the case, why would you ever consider not trading via a spread bet? Okay, so this is a great question that had in by. This is a question from a subscriber, and appreciate all your questions and your support. Thanks, guys. But this question is a great question. It's like, why would you not spread bet? So there's a couple of reasons I can see why you wouldn't spread bet. The big one for me is if you have a strategy which you require direct access to the market. So I'll explain what I mean. So a spread bet, you basically have two prices to take. And if you're trading spot FX, it's very similar as well. So whatever the market may be, let's say it's ABC, you've got your bid price here at 50, you've got your ask price here at 51. This is what the order ticket kind of looks like, doesn't it, on the platforms? And if you want to buy long, you want to go long, you kind of hit the button at 51, you're long at 51, you want to go short or sell at 50, there you go. You put in your size and all that kind of stuff. And that's fine. You basically can only take the market. You can't do anything else but take the price that's given to you. However, in the real market, in inverted commas, if you had access to this, let's say this was a futures contract or it was a stock, you're unlikely to have access to this if you're talking about currencies. But let's say futures or stocks, you would have an order book, and the order book would say 50 to 51, and then below it would be like 49.5, 49.25. You get the idea. I've kind of done a video where I've talked about level 2 and how it all works, and go and check that one out if you're interested and you're finding out more. But ultimately, this is the order book, and in the order book, you can put in your own orders. So if you want access to kind of in between the spread, you could effectively put your order in. So in this example here, let's say the minimum spread is 0.25. In this example here, instead of me paying 51 like I'd have to do with a spread betting company or CFD company or spot company, I could go in and I could put my order in for 50.25. So I could come in, put my order for 50.25, whatever size that is. That could be 1 share, 100 share, 1,000 shares, 1,000,000 shares. As long as I've got that in my brokerage account, I can do that. And this would go directly onto the exchange, and then that price would then be 50.25 to 51. Now I can only do this if I have exchange access. I have access to NYMEX on crude oil, I have access to CBOE, whatever it may be. If I'm not trading options, or if I've got access to the NYSE, NASDAQ, you get the point. If you've got access and you've got the credentials and you've got the money in your account, you can do this. So that then allows you to buy at 50.25. Now, without going into kind of going over old ground here, guys, you're not guaranteed that fill, but if someone comes along and takes that price from you, you're bidding the 50.25. Someone says, yeah, you know what, I'll sell at that price. You buy at 50.25. This is something you can do only on the exchange. You can't do if you're spread betting. Now, you might say, well, that's not really much relevant to me because if I'm buying at 51, I'm looking for kind of a 100 pip move. And if you're doing that, then yes, you may as well do that, pay the spread, and you get the tax benefits that you get, most people get, like I say. And by the way, let's just get the risk out there, caveat out there. Go get your own tax advice, guys, just to be sure. I'm not an accountant, I'm not a tax attorney and all that kind of stuff, so sort your own stuff out in terms of that. But this allows you to buy at a cheaper price. Now, if you're looking for those bigger moves, it doesn't affect you. But however, if you're scalping, let's say you're very actively scalping, or you believe you've got some sort of edge by, bidding and offering and kind of making a market, you can't do that on here. You can't make a market. You have to buy at the ask and sell at the bid. Whereas here, you can make a market. So let's say you've got, 15 different shares that you've got bidding and offering, and you probably would have to have an algo to do this. I'm just kind of picking this hypothetically. You could be bidding and offering on these shares across all these 15 order books, taking the spreads from each and grabbing opportunities like that. It could be a share that hardly ever moves. And this was something that was probably popular years and years ago, where people would trade for rebates, where they would put their orders in on either side of a very, very thick share that never moved. When they got filled and they were actually providing liquidity, it's called, they would get a rebate back from the exchange for providing liquidity. And even if they just made a tiny bit of spread or broke even on the actual trade, they'd make money net because the exchange was paying them to provide liquidity. So there are certain things like that, and so say if you're scalping across the order book that way, or going back to that example, you might have a large amount of shares that you're making a market on, and you're kind of doing that all throughout the day. Impossible to do with a spread betting platform, CFD platform, whatever. You might also be trading something that's very, very thin. Okay, in terms of the order book often goes wide. So we're used to kind of Euro US dollar and GBP USD where spreads are nice and tight. Majority of the time they're very, very tight spreads, and we can trade those reasonably size whatever we want, whenever we want, unless it's a really fast market. If you're trading something thinner, let's say it's like a stock, or it doesn't even have to be that much of a low stock, to be honest. Some kind of FTSE 250 stocks in the UK are reasonably thin spreads, especially in the morning, and wide spreads, thin liquidity. So you might find, instead of being 50 to 51, you might find it being something like 50 to 65, for example, like 550 to 565 is perfectly feasible. In which case, if you're trading that, you're giving up 15p straight away. If you're buying that in the morning, that might not be feasible. If your strategy is to trade early in the morning and capture some sort of move on these thinner stocks, you're probably going to have exchange access, because you want to be coming here and bidding. Yes, you could bid 551, but you're probably not going to be filled. Maybe you could be a little bit more aggressive and start to bid like 555 to make it 555, 565. So you get taken at 555 and you're now long at 555. Whereas if you're going directly on the spread bet, you have to pay 565. You get the point. If you need that direct access, that is really one of the main reasons why you wouldn't want to spread bet. Another reason could be that if you're using it as a hedging tool. So this is kind of a really unlikely event for most of the people watching this, and for us as retail traders, we're just looking for speculative purposes. We want to speculate, and when we're right, we want to make money, and then we're prepared to lose money if we're wrong. If we're hedging, maybe we're hedging currency exposure, a company hedging currency exposure in terms of, they're receiving, 10 million pounds in dollars some point in the future. They might want to hedge that and lock that in and know exactly what they're getting in terms of GBP now. And so they would do a trade on the currency market to hedge that exposure. They wouldn't want to do a spread bet because they don't want the fact that it's tax-free, because ultimately if the hedge doesn't work, they want to offset the loss they've made on this against the gain they've made on the capital gain of the FX trade, on the deal they've done, whatever it may be. And so they want to be completely neutral. If they did a spread bet and they won, of course, and actually I think there's a little bit of an anomaly in terms of companies, it's not quite clear cut, but let's use a hedging example as a good example. That's tax liable, a spread bet is not. That's great in terms of if that suddenly loses money and the spread bet makes money, because theoretically, like I say, it's not quite like that, but theoretically there's no tax implication. But of course, hedge can go both ways, right? You could lose money on your hedge and you want to be able to claim the tax back on the loss of that, offset against the gain you've made elsewhere. So that might be one unusual reason why you wouldn't spread bet. And of course, the final thing is just the instruments on offer. The companies do offer, most companies offer a decent wide range of instruments to trade and markets to trade and underlyings to trade, but you might have a specific requirement for something that's just not there. Maybe it's a super exotic pair. Maybe it's a specific share on a specific exchange in another country, or a very small share in a local exchange that they just don't offer because they don't have the liquidity for it. So if that's the case, then you want to need to go directly to the exchange and trade it directly on the exchange. So those are the real reasons why you would not spread bet if you live in the UK. Not very many, but for most of us, like I say, casual traders trading currencies or the major indices or the major stocks over a kind of swing trading period with reasonable, not massive size and average size, spread betting works out very nicely. All right, guys, the next one. Take care. Bye-bye.